Hello, my name is Sue Miller, and together with Ed Davis, I head up the Banking and Financial Services Litigation Group at Stephenson Harwood. Welcome to the fourth in our Autumn 2016 series of 4 short webcasts, in which we take a bite-sized look at some of the key themes emerging in financial disputes over the last 12 months. In today's webcast, Ellen Gallagher, an associate in our Banking and Financial Services Regulatory Litigation team, will take a look at recent developments in the FCA's approach to remediation and consumer redress schemes.
The requirement for firms to conduct remediation exercises has become a central pillar of the FCA's response to regulatory breaches, and the importance of consumer redress was emphasised in the FCA's mission statement published on the 26th of October. Over the past 12 months, the way in which remediation is conducted has come under review. In May, the Public Accounts Committee published its report on regulation and redress in financial services mis-selling, which raised concerns about the efficiency with which claims are processed and about the role of claims management firms. In addition, the FCA has reconsidered the open-ended character of the redress exercise conducted in response to the widespread mis-selling of payment protection insurance, or PPI, and has consulted on amending the rules of that scheme to impose a 2-year deadline on fresh claims. In this webcast, we're going to look briefly at how and when firms might find themselves under an obligation to conduct a remediation exercise, and to consider what lessons can be drawn from the response to recent schemes to see what approach the FCA may now expect firms to adopt. Remediation is a hugely expensive business. We often focus upon some of the eye-watering headline fines that the FCA has issued when considering the cost of regulatory failure. But where customers can be shown to have suffered detriment, the cost of providing redress can now far exceed any financial penalty that the regulator is likely to impose. Just to illustrate this, from 2011 to date, the FCA has imposed an aggregated total of £3.1 billion in fines upon firms. During the same period, the aggregate amounts paid out in consumer redress, just in relation to PPI alone, totals around £22 billion. Remediation exercises will generally include a number of elements, only one of which is the consumer redress piece. The part of the business in which the misconduct occurred will also be scrutinised. A risk mitigation programme may be established to address any issues which caused or allowed the misconduct to occur, perhaps in the control framework or relating to sales or advisory practices. As part of this programme, measures will be put in place to remedy those particular deficiencies on a timetable to be agreed with the FCA. A risk mitigation programme may go hand in hand with enforcement action against the firm, or it may, as is more usual, be established by the FCA supervision team. The programme may involve the production of a skilled persons report under Section 166 of the Financial Services and Markets Act, or FSMA. A Section 166 investigation will be conducted by a skilled person nominated or approved by the FCA. This will generally be either a firm of accountants or solicitors, depending on the nature of the material to be reviewed. Such an investigation will inevitably prove costly for the firm, since, although the skilled person will be nominated by the FCA and will owe their duties to the FCA, it is the firm itself which is required to pay their fees. It will also be an expensive process in terms of management time and manpower during the information gathering part of the investigation, when the firm's cooperation will be required and relevant individuals may be interviewed by the skilled person. Outside of the context of a full redress programme, the obligation to provide redress to individual customers will arise on a daily basis and be managed through DISP, the FCA's complaints handling framework, and through the work of the Financial Ombudsman Service. DISP sets out a number of rules governing the way in which firms must handle individual complaints. If the customer is not satisfied with the outcome of their complaint to the firm, it may be escalated to the Financial Ombudsman Service, or FOS. The FOS determines cases on the basis of what is fair and reasonable in all the circumstances. It is generally disposed to adopt a consumer-friendly approach and is able to make binding awards of up to £150,000. Once accepted by the consumer, such financial awards are full and final. It is not then open to them to bring a civil claim against the firm for the balance of any remaining losses, so long as the facts relied upon at the FOS are not different from those which would be relied upon in court. Where consumer detriment is found to have occurred on an industry-wide basis, the FCA may make rules requiring all affected firms to establish and operate a consumer redress scheme under Section 404 of FSMA, as it did in relation to the mis-selling of PPI and interest rate hedging products. The types of misconduct which cause consumer detriment to arise will generally fall into one or both of two categories: those which are caused by failings in the design of the relevant product, and those which are caused by mis-selling it. Where only mis-selling is found to have occurred, each claimant must meet an evidential threshold in order to demonstrate that such failings occurred in their particular case. Where deficiencies are discovered in the product itself, each customer who purchased the product may be automatically deemed to have suffered a loss. It is worth noting here that redress payments will often be in the nature of a liability and may well be covered by a firm's liability insurance. Clearly, insurers will wish to be involved before payments are made, and certainly prior to any acceptance of liability. Prior to 2010, the FCA had no power to impose consumer redress schemes on individual firms. Since the introduction of Section 404F7 of FSMA, the FCA may now do so where it considers there to be potential for mass claims on a single issue. The requirement is imposed by way of a variation of the firm's permissions, and the FCA is not obliged to consult before doing so. Since the introduction of the Financial Services Act 2012, firms may also apply for such a requirement to be imposed by the FCA, effectively entering into the scheme voluntarily. The FCA's powers under Section 404 are triggered when the following factors apply. 1. There has been a widespread or regular failure by the firm to comply with applicable requirements. 2. It appears that, as a result, consumers have suffered or may suffer loss or damage, in respect of which, if they brought legal proceedings, a remedy or relief would be available. And 3, the FCA considers it desirable to set up a scheme, which essentially means that the FCA will consider whether it is proportionate and efficacious to do so. Once a redress scheme is established, the DISP rules cease to apply in the normal way to complaints under the scheme, and instead, a scheme-specific dispute resolution procedure will be put in place. Customers who are unhappy with the outcome of that procedure may escalate their complaints under the scheme to an independent adjudicator and from there to the FOS. However, the FOS is bound to make its determination within the framework of the redress scheme, and it may not look behind that to address whether or not the scheme itself is fair and reasonable. This provides a degree of comfort for firms that every case will be processed under the agreed scheme rules. In its report of May of this year, the Public Accounts Committee raised concerns over the significant role played by claims management companies, or CMCs, in the claims made by affected consumers in the PPI scheme, in which an estimated £5 billion of compensation was paid not to consumers but to CMCs by way of fees. Giving evidence before the committee in March, Tracy McDermott, then Chief Executive of the FCA, emphasised that the regulator regards a simple and streamlined claims process as desirable in order to eliminate the role of CMCs. She suggested that structuring a redress exercise as a scheme of arrangement was one way in which this had been achieved in previous schemes, using as an example the scheme implemented by Card Protection Plan, or CPP. In recent years, a number of firms, such as CPP, have operated consumer redress schemes through the mechanism of a scheme of arrangement under Part 26 of the Companies Act 2006. Schemes of arrangement involve an agreement among creditors whereby they compromise their debts under the framework of the scheme. It is generally associated with insolvency, but can also be employed by a solvent company in order to silo its redress liabilities and to provide a more straightforward application process for customers. There are a number of features of such an arrangement that are evidently factors in deciding whether to employ that structure. Firstly, it provides the firm with a bar date beyond which all claims are deemed to be extinguished, since a defined timetable for the scheme is required under the Companies Act in order for the court to approve it. Contrast this with the open-ended nature of the PPI scheme. Secondly, the claimants under the redress scheme, as creditors under the scheme of arrangement, must vote to approve the scheme before it is presented for sanctioning by the High Court. In order for that vote to be carried, a majority in number representing 75% in value of those creditors present and voting must vote in favour. Once approved by a vote of creditors and by the court, the scheme is then binding upon the entire consumer population, even those who did not vote or who voted against the scheme. Thirdly, a more streamlined claims process can be employed with standardised forms, submission and escalation processes. This not only helps to weed out spurious claims more effectively, but also eliminates the role of CMCs. The FCA closed its consultation on proposed rule changes to the PPI scheme on the 11th of October, and it is expected that these will come into force between December 2016 and June of next year. Changes will include the launch of a consumer communications campaign to be funded by a fee paid by a number of the affected firms, and the introduction of new rules and guidance on handling PPI complaints in light of the decision in Plevin and Paragon Personal Finance, in which the Supreme Court ruled that a failure to disclose to a client a large commission payment on a single premium PPI policy made the relationship between lender and borrower unfair under Section 140A of the Consumer Credit Act. The proposed 2-year deadline on new claims is also expected to be introduced. While remediation inevitably imposes enormous burdens on firms, this recognition that the PPI issue must now be brought to an orderly conclusion indicates that the FCA is alive to the need for redress schemes to be framed in such a way that a clear deadline is imposed and that all claims received can be handled as efficiently as possible. Ultimately, this should prove to be in the interest of consumers as well as firms.